Welcome back, children. I hope you've been doing the admission sums based on the previous videos that I've uploaded, and you are pretty comfortable with what is the meaning of goodwill treatment when the new admission partner joins in at the time of admission, then the revaluation of assets and liabilities, which we discussed in the previous video. Yes, so this is a kind of sum. We will be doing a bit of revaluation and the goodwill treatment when the partner is bringing in his capital and goodwill, and also making the partner's capital accounts post admission and the fresh balance sheet after the new partner has been admitted. Alright, so we need to get ready for a full-fledged sum on admission. Ready? So have a look at the sum. Alright, so what is the sum telling you? A and B were partners in a partnership firm. This is sum number 40 of the Goodwill. And they were sharing profits and losses in the ratio of 3:1. On 1st April 2018, they admit C as a new partner. And the terms were: C is to bring 1 lakh as his capital and 50,000 for goodwill, and half of which is to be withdrawn by A and B. Alright, so here this is what C is bringing in his share of capital. That will be credited to his capital account. Cash is coming in, right? Journal entry is bank account debit to or cash account debit to C's capital for 1 lakh. But for 50,000 goodwill, PFG account debit, bank account debit to PFG, this is what the goodwill has come in. How will it be distributed? In their sacrifice ratio. Wonderful. Sacrifice ratio is not given specifically in the sum. Neither the new ratio, but information is given about it in point number E. C is to be given 1/5 share, and the profit sharing ratio between A and B shall remain same. Whenever the profit sharing ratio, which is the old ratio, new ratio between the old partners, does not change, the sacrifice ratio is the same as the old ratio, meaning 3:1 is the sacrifice ratio, and that is what I have written here. The sacrifice ratio is 3:1. How much PFG is being brought in? 50,000. So this total of 50,000 gets divided in the ratio of 3:1 between A and B, and that comes to 37,500 and 12,500. This is what A and B will be credited with, right? PFG account debit to the sacrificing partners, meaning to A's capital to B's capital. Clear? That done? Then, so this will be a part of the goodwill. Second thing is, you also have to make the capital account. You have been given the balance sheet, a new balance sheet is to be framed. There have been certain revaluations of assets and liabilities. That we will give effect because we need to make the revaluation account. We will show you there. So let us start making these accounts. What all do you need? You have been asked to give necessary journal entries, which I am discussing here. Then you have been asked to make the ledger accounts and the balance sheet. So ledger accounts mean revaluation account and the partner's capital accounts. Alright, this you have to make at the time of admission. Okay, so let us start with making the accounts here and the balance sheet. The balance sheet figures, let us start with the balance sheet figures. What is given in the liability side? Sundry creditors, 3,50,000. There is no change, meaning no change in the liabilities, right? The sundry creditors amount here. Therefore, that same amount can be put in the fresh balance sheet post admission. So 3,50,000 comes here. This is the fresh balance sheet, and what is the date? 1/4/18. The date of admission of the partner. Okay. So this remains the same, no change. Partners' capital accounts A and B are given, so that we will bring forward here. Both are having a credit balance, so balance brought down. 4 lakhs of A, 2 lakhs of B. Alright, C of course was not there, so right now no balance brought down for C. On the other hand, we have assets. Cash in hand is 40,000. Of course, I put cash in hand here, but I will not put it in the outer column because further cash is coming in as capital PFG and is being withdrawn also. I will see what is the net amount of cash after all those transactions are done. Then other all accounts are changing. Okay, book debt, stock, machinery, fixtures, all are land and building, all are being revalued. So we will put the revalued amounts here of the assets. Alright, so let us go with the first one. C brings in 1 lakh as his capital. Okay, bank account debit. So this is add C's capital, 1 lakh comes in. So here, and in C's capital account I will show buy cash 1 lakh. I've given effect to the journal entry, cash account debit to C's capital. He also brings in goodwill, so PFG debit. So basically this one, add PFG also here. Cash is coming in for PFG 50,000, correct? And that PFG will be debited and credited to partners' capital in the sacrifice ratio which we have found here. So PFG account debit, A is getting 37,500, B is getting 12,500. Done. Capital brought in, shown in capital account. PFG added to cash and distributed to sacrificing partners. Done. After that they have withdrawn also, half of which, meaning half of the goodwill, is withdrawn by the old partners. When you withdraw, obviously cash is going out. So less 25,000, half of 50. This is withdrawn, PFG withdrawn. Alright, 25,000 gone out of that. These are all plus, this is minus. And who has taken it away? The old partners in their sacrifice ratio only. So this will be like 2 cash account, half of this, half of that. So this is 6,750, if I am not wrong, 250. 6,250 and this one is 36. So 1, 8, 750. Alright. This is the amount of goodwill that both of the partners have withdrawn. Alright, this comes to 25,000. See this? 14 and yeah. So, this is withdrawn from the business. All done. So, adjustment number 1 taken care of. Adjustment number A. And then we come to B. The value of land and building is appreciated by 15%. I have given effect to that, all the calculations. Book value was 3,30,000. It has appreciated, so we will add the increase. 15% of 3,30,000. This is coming to 49,500. So if I add this, the fresh value is this. This is the increased amount. Very carefully note this, children. This is the increase. This should go to revaluation account, right? Because that is the gain. And this should go to the new balance sheet because this is the revalued figure. Alright. So land and building will appear at the increased value here, 3,79,500. And what is the journal entry for this revaluation? Land and building account debit to revaluation. So buy land and building 49,500. Please understand this well. Book value is already this much. I have to add this 49,500 and therefore I have got that fresh figure. Clear? So this is increase in asset. Increase in asset is a gain. So it comes here on the credit side of revaluation. But the other assets which are stock, machinery and fittings, fixtures basically, are going down in value. One is being reduced by 7%. So 1,80,000 stock minus 7% of 1,80,000. This is the revalued figure. So stock has reduced. So we put the reduced value here, 1,67,400. And how much is the reduction? This 7% of 1,80,000. So reduction is a loss. I put it here. Which account do I credit? Stock account. Journal entry, revaluation account debit to stock. Asset is credited, meaning value is reducing. Then same thing happens with machine and fixtures. So this is machinery and fixtures. That is falling by 10,000, the value of machinery. 5% of 2 lakhs. So if I subtract that, the new value will be 1,90,000. Alright? So machinery and fixtures is 1,90,000 post the fall in the value. So all these three figures have come here. The reduction in the value has gone here. Easy? Then, that provision for doubtful debts is to be made at 5%. Provision for doubtful debts meaning whatever are the book debts meaning debtors. Debtors are 2 lakhs, 5% of 2 lakhs is again a loss to me, isn't it? Provision for doubtful meaning I am having doubts whether I will get this or not. So how do I create provision? Revaluation account debit to provision for bad and doubtful debts 10,000, 5% of 2 lakhs. Here in my book debts 2 lakhs less provision for doubtful debts 10,000. So 1,90,000 here. Alright. So we have created a provision account. Please understand this is not bad debts. So we are not writing off book debts. Book debts are worth 2 lakhs. We are creating a provision. This concept comes from your class 11. Same thing. So here we have this. Then 15,000 is provided for an unforeseen liability. See, this is an unrecorded liability. Abhi tak kuch nahi tha. Now unforeseen liability probable hai. So we are creating a provision. So it's a loss to us because that might be an actual liability. So we are creating a provision for liability. 15,000. Alright? So liability. Come here. Provision for liability. 15,000. So an unrecorded liability, a provision has been recorded now. Therefore, it comes there and here because it's a probable loss to me. Then 11,000 is to be received as commission, hence it is accounted for. Is to be received, meaning it's accrued commission. Commission earned but not received. It's an asset to me. All assets. It's an unrecorded asset coming into picture. So it is accrued commission debit. How much? 11,000. And I will credit revaluation account because it's a gain. So it is accrued commission. Commission earned but not received. Is it okay? Fine. All these things done. I have put all other remaining assets and liabilities in there. Nothing I have missed. Just check that once. And capital PFG treatment done. Everything done. Now we need to just get to closing these accounts. Alright. So let us see revaluation. These are the two places where I have gained and these are the losses I have made. So net kitna loss hai ya profit hai. If I see that this side total is coming to 60,500. So 60,500 here because I see that this is lesser and my profit, if I subtract from 60,500 all of this, the balancing figure is coming to 12,900. Meaning this is my gain on revaluation. Obviously again, credits are more, debits are less. Understood? This is the credit side. Revaluation account, I told you it's a nominal account. Right? Now this profit is to be credited to the old partners in the old ratio, journal entry, revaluation account debit to partners, capital accounts A and B in the old ratio, not sacrifice. PFG is shared in sacrificing ratio, but this gain will be in the old ratio. Old ratio is 3:1. So if you divide like that, it comes to 9675 and 3255. Okay. Alright. So this is the gain. Partners capital being credited. So it should come here. By revaluation 9675 3,225. C doesn't get any share of revaluation profit. This is closed. Now let us close this. Let us find out how much is their balances, which we will put it here. Yes, capital accounts of A, B and C. We will put it here. Okay, so let us total up these accounts. And so here we have done the totaling. Okay, avoided the calculation, so waste of time. What did I do? C, I found out C is credited with 1 lakh and therefore no debit, so the balance, closing balance is 1 lakh. What about B? B is credited with these, so I totaled it up. This is the total. From there I subtracted whatever he has withdrawn, 6250. So this is what is left in his account. Similarly A, this plus this plus this, coming to this. So it is coming to 4,47,175 minus 18,750 that is withdrawn. This is the balance left. We will put these balance there. 4,28,425 is A's closing balance. B's closing balance is 2,09,475 and C is 1 lakh. So this total of capital I have put in here. After that, I have totaled up the assets and liability side, of course, and cash balance also I have found out. 1,65,000 is the new cash balance after capital has come in, PFG brought in and withdrawn. Alright, so your balance sheet obviously will tally after this. So this is how we make a full-fledged sum on admission, where you have revaluation of assets and liabilities, new balance sheet and the partner's capital accounts. Okay. Now we will take further in the next videos the various other treatments of related to admission. Till then, I hope this goes down well with you children. Practice that sums and be comfortable and do accounts in the simplest of way with me. Thank you so much for watching. Please like my channel. Please like the video if at all you found it nice. Thank you.